Well, they did it again. The S&P and the NASDAQ both closed the week and the quarter at all-time new highs. S&P settled at 5790 last week, up even more on Monday, and that NASDAQ 19,860. They're both on fire after the lows of mid-April. This marks the fifth straight week. Let's talk about it. Stay with me. The CB3 Financial Weekly Update and the monthly summary starts now. Well, let me start with the headline that matters. Both the S&P and NASDAQ closed at fresh long-term highs last week, and I mean genuine breakout to new territory highs. S&P pushed through 6,200, and the NASDAQ surged right along with it, with both indices now up approximately 5% year to date. Here's the context that's crucial, though. These aren't just incremental gains. We're looking at a powerful rally of over 20% since the April lows. Yes, you heard that right, 20% in just roughly 2 months. This is the kind of move that we want to see sustain into the next quarter. Now let's talk about market sentiment. Certainly the VIX being at a 16 handle. Now you hear me talk about the VIX, the volatility index. Once it gets down to 16 point something, that generally means it's going to stay in that area until the next scare happens, and then it'll surge back to 20 and even higher. But right now, what's in the news is the great big beautiful bill from President Trump. It is one of the most significant pieces of legislation and is what is driving the market right now. This massive piece of legislation, formerly known as H.R. 1, the One Big Beautiful Bill Act, passed the House in May and just passed the Senate today. It was 215 to 214 in the House and 51 to 50 in the Senate. So there's no landslide victory here. And this just isn't any bill. We're talking about Trump's cornerstone legislative agenda, the major tax cuts, border security funding, and pro-business provisions that could fundamentally reshape the economic landscape in America for decades. The market is clearly betting on the passage of this bill, and that's why you see the strength in the market despite what happened today. This was just normal profit taking today, Tuesday, July 1st. What I want you to understand, though, is the markets are forward-looking. That's a mechanism that they design themselves. The markets are always going to be forward-looking. They're not just pricing in the bill's passage. They're pricing in economic growth expectations that come with it. And we are riding on that coattail because our growth program, CG, and our growth and income program certainly depend on that growth. And our DS program, which is all Mag 7 or really Mag 8, including Berkshire and AI stocks, is definitely counting on the economic engine of this bill coming true. So the second factor is the Federal Reserve policy expectations shifted to a more dovish direction. The bias, despite Donald Trump and Jay Powell not agreeing, the bias of the overall Fed is that the market is now pricing in a 20% possibility of a rate cut at the July FOMC. That's this month, up from just 16% a week or so ago. When the Fed cuts rates, the market loves it because it means you can't make money in a savings account and you pull it out of that and you put it in the market in some way, shape, or fashion. And third, and most significant to me, is this wasn't just a rally of high-tech or semiconductors or mega-cap stocks. This was broad-based, across-the-board participation in this rally in these last few weeks. Not just the mega-cap tech sector performance. We saw strength across all sectors, including the conservative sectors of consumer staples and utilities and real estate. So given this market environment, we are continuing to be fully invested in all programs. All the programs are full speed ahead for what we believe is going to be a strong rally through the summer, a traditionally quiet time, but especially if this bill is passed and signed into legislation. Trump is looking to do this on July 4th, which is just 3 days from now. We'll see if that happens. I'm expecting that it will. Looking ahead to the next week, we have several very important considerations. This is going to be a holiday shortened week, obviously, because the 4th of July falls on a Friday, which means lighter volume on Thursday. The most significant event will be Thursday's unemployment report. Normally, the unemployment report is the first Friday of the month. Well, the market will be closed because of the holiday. So unemployment moves up to Thursday, and we'll see if that changes the market participants and how they react to it. I believe you're going to see the volume on Thursday afternoon look like Christmas time. People are going to be leaving, going to the beach, and making it a 3.5-day weekend. So we're entering the heart of second quarter earnings seasons, all right? We'll start it off after the holiday weekend with the banks reporting first. I think expectations for earnings have been somewhat curtailed because of tariff-related uncertainties, and there's a potential for positive surprises, particularly in sectors benefiting from the infrastructure and energy provisions in the big, beautiful bill. So let's be clear about the risks we're monitoring for you, our listeners, and our clients. Valuations are stretched right now. When the market's at a lifetime high, it's really hard for the valuations to be in sync or fair value, if you will. But that doesn't mean the market can't keep going higher. The secret, of course, is to stay fully invested until such time as the market begins to turn, and then we begin to lighten our positions. Additionally, as I said earlier, the VIX 16 handle suggests complacency, which means that if there were a downturn, it could be fairly abrupt. I don't see anything more than a 4 to 5% correction, which would be in line with the seasonal tendency of both July and August and even September. You may remember that September historically is the worst market performing month of the year, meaning that much of the time it comes in negative, the only month of the 12 that has a 50-year history of performing negatively. So let's move through this holiday week. We're going to get into the back half of 2025. I hope you guys have a fantastic holiday weekend. This is the 249th celebration of our great country, the United States of America. Everybody after this Friday will be looking forward to next year and the quarter millennium anniversary of the United States of America. Now, we've learned from our overly cautious positioning since April, we did not stay overly cautious for very long. We flipped and got fully invested back into the market and have made up some ground in all of our programs. So this big, beautiful bill, the improving geopolitical conditions, and the potential for a more dovish Federal Reserve all create a backdrop for continued equity strength. That's what we're counting on. That's how we're invested. And if we need to adapt, we will do so, as you all know that. So that wraps it up. That's the week's update. Plan on having a fantastic time. I hope you can watch some fireworks. We will be doing that from the terrace of our home, and we will wish you and yours a very happy and safe 4th of July. We will see you next week. God bless America. Thank you, guys. See you next time.